So ladies and gents, it's now 2:30, so it's a perfect time to start this afternoon's talk. And this afternoon's webinar is entitled My Estate Planning Matters, Long-Term Care, specifically for Scotland. Now, let me just introduce myself today so you know who's speaking. So my name is Greg March, and I'm a Senior Financial Education Coach for My Money Matters. And I've got the pleasure of taking you for the next 25-30 minutes or so, exploring the benefits of understanding long-term care. Just before we start the webinar, though, let me just point out a couple of things. First and foremost, the information I'm about to give you today has been designed purely for educational purposes only. So please don't take anything that I say as recommended financial advice. And also, we've based the information on a current understanding of legislation and tax treatments, and this could change in the future. And again, be aware these webinars are recorded for training and compliance purposes. Now, during today's talk, if you have any questions, feel free to ask those questions. And the format for asking questions today is by using the Q&A box that you can see on the right-hand side of your screen. So if you have a question, drop it into the Q&A box. And then what I will do is I'll answer that question for you at the end of the talk. Now, what we're going to look at today is we're going to look at the following. We're going to question what is long-term care. We'll ask the question who pays for long-term care as well. And what about the savings you may have? And then finally, we'll talk about what you yourself can do when it comes to long-term care. Now, the unfortunate thing with this type of webinar is there's lots of information I'm about to throw at you, and there's probably far too much information for you to retain in just one sitting. So what you could do is watch the webinar today and then maybe come back to it at a later stage. So revisit the webinar, and the more you come back, the more of the information you're going to retain. But ultimately, you could also seek regulated financial advice as well for yourself when it comes to long-term care planning. So that will then help you with this journey. So the first question I'm going to pose then is, what is long-term care? So really, support that's required when the unexpected happens. And that could be for yourself, that could be anything in relationship to the following. If you're unable to perform what we call your activities of daily livings, or as they refer to, ADLs. So this could be, bathing yourself, feeding yourself, and so on. We'll cover those later. It could also be because of disabilities occurred and you need extra support getting around. It could well be that you have a long-term illness that can strike any of us at any given stage. And unfortunately, it could also be down to the fact that we may be suffering with mental incapacity as well. And as we mentioned, remember, this isn't just something that happens for the elderly. This can happen at any given stage. So let's look at these things that we call activities of daily livings, or ADLs. So what are they? And this is how a lot of the councils will actually look at you to see whether or not you are able to claim for care. So ADLs, as they're referred to, are basic self-care tasks performed by an individual on a day-by-day basis. And the fundamentals for self-care, and they include the following. Functioning mobility, so this is walking and transferring in or out of a bed or a chair. You've got personal hygiene as one of those self-care issues. So this is oral care, cleaning your teeth, brushing your hair, and the ability to have a shower or a bath. In addition to that, we've got toileting. So do you have trouble getting on or off a toilet and cleaning yourself afterwards? One of the other ADLs is dressing, so the ability to choose your clothes and dress yourself efficiently, and also self-feeding. Have you got the ability to feed yourself? So they're the ADLs that they look at when assessing you and your care needs. Now, when we talk about care, remember care can come in two different flavours. The first flavour is where you get care in a residential care home. And this is where you get help with those ADLs, such as washing, dressing, meals, and you also have social activity as well. And the other flavour of a care home is a nursing care home, where you get all the above, plus you also get additional registered nursing care to help with you with your individual needs. So when you're looking for support, you remember there are two flavours, and unfortunately those flavours don't come cheap. And in fact, the average cost for a residential nursing home, a residential care home, is £671 per week, and that's according to ageuk.org. So that £671 per week equates to nearly £35,000 per year, purely for the cost of a residential care home. Now, if we add on top of that the need for nursing care as well, and you're in a nursing care home, the average cost goes up to £845 per week, or put it another way, 44,000 just short of per year. And there are differences with different regions, so it depends on where you live. Then it could be slightly more expensive, and it could also be slightly less expensive too. So there are lots of regional variations when it comes to these costs. But as you can see, though, £44,000 is a lot of money out of anybody's pocket. And because of that, then this becomes big business. And in the marketplace, the offering of care homes has changed dramatically since 1980s. Because if we go back to 1980, then the majority of beds were offered by the NHS, local authority, and not-for-profit organisations. In fact, in 1980, there was 225,000 beds offered for care purposes. Today, the public sector, they only offer 25,000 beds, and the rest of it's been provided now by the private sector. So the private sector, the industries that are making the money now, there's over 380,000 registered beds offered by the private sector. And that's because purely £44,000 per year from everybody's pocket is big business, and it makes sense for them to move into this sector. So unfortunately today, care is a business, and because of that, we need to pay for it. So the question goes then, excuse me, who pays for long-term care? And this will depend upon the type of care that's actually required. Now, historically, most people thought that the NHS was responsible for funding long-term care, but that's a bit of a myth. It's down now to generically the individual that needs the care themselves. But there are certain support packages that are available in the marketplace. There's the standard rate support, you've got self-funding, you've got personal and nursing care payments, and also it could be fully funded. So what I'm going to do is just take you through these and talk about what they actually mean. So let's start off by talking about the personal and nursing care payment. So this payment itself is non-means tested. So that simply means it doesn't really matter what you've got in the bank or building society, because this isn't linked to your personal wealth. So it's non-means tested. And personal nursing care payments will be paid directly to the care home. But if you're in receipt of attendance allowance, if you then get personal and nursing care, then you can no longer keep claiming your attendance allowance. And then specifically for Scotland, the personal care payment is going to be £248 per week, and that's under the new rules. And if you need nursing care, then that's an additional £112 per week. And that payable for 24-hour nursing care is assessed as needed. So if you need the nursing care, it'll be assessed, then it'll be reviewed on an ongoing basis. Now, if you need to find out more about the assessment, I would highly recommend that you look at careinfoscotland.scot, and they'll go through what's assessed when they look at the assessment for nursing care. Now, you've also got the self-funded option with a bit of support from the state. Now, because this is self-funded, then it is going to be means tested. So it simply means that for you to get any support from the state, they need to look at what you've got and what you're worth. And what the financial assessments officer will be looking at is everything you've got when it comes to financials. So they'll look at your earnings, they'll look at your pension benefits you've got, they'll look at benefits elsewhere, they'll look at your property, and this includes property here and overseas, and any form of savings you've got as well. So when you're looking for this, then just be aware they will assess you and they will means test you for this particular benefit. And also, if you're thinking about maybe disposing of some of your assets, if you think you might need care, then just be aware of this rule called the deliberate deprivation rule. So if you know that you need care and you start transferring your assets prior to an assessment, when you knew that you needed care or reasonably knew that you should need care, then this will be counted as part of your overall estate for the assessment purposes. So just be aware of the deprivation rule as well. And also, property is taken into account when they do your assessment, but they can disregard your property under the following situation. So if you're living on your own before you need care and nobody else has a share of the property, then what the authority will do, they'll look at 90% of the value of your property, and that'll be taken into account. So 10% is left, and that 10% is left so that you've then got the funds, should we say, to cover the fees of selling the home when you go into care. But if you've got people living inside your property, then it may be disregarded. So if someone's living in your home as their main residence when you need care, it won't be taken into account. So that could be a spouse or a civil partner, a relative of yours that's over the age of 60, so a close relative, a relative that's got incapacities. All of these scenarios potentially means that the house will not be taken into account when they do your financial assessment. And also, if the care that you require is just temporary, so for a short period of time, again, they won't force you to sell the house. And when you do go into care, just so they make sure that it isn't temporary, if that makes sense, then for the very first 12 weeks of care, the value of your property isn't taken into account when the assessment's done. But if you do sell the property within a period of 12 weeks, then they will, of course, take into account the value of your assets there. So we've also got disregarded capital. So certain investments won't be included in the assessment if they're things like investment bonds with life cover. So this is where you're investing into a bond that has normally a 1% life cover. That's going to be disregarded when it comes to your assessment. Also, surrender values of life insurance policies or annuities or pensions can be disregarded as well for the assessment purpose. And if you're in the situation where you've got joint accounts, then they'll look at 50% of the value of that joint account, and that will then go towards the assessment. So because of that, in certain circumstances, it may be wise for you to have separate accounts, because then you get more of an accurate assessment going forward. But what I would say, irrespective, is speak to the appropriate regulated financial advisors and get the right advice for yourself. So with self-funded care, then what you've basically got is, if you've got savings over 35,000 for Scotland, then there's no additional support. But you're still entitled, though, to claim for the personal and nursing care plans that we spoke about just a few seconds ago. Now, if you've got income or capital between 21,500 and 35,000, then there is a tariff payment where you're expected to make a payment towards the care. And if you've got less than 21,500 as of the 6th of April 2024, then you'll get standard rate support. So let's start off by looking at tariff payments. So what a tariff payment is a tariff payment is due if you've got savings between 21,500 and £35,000. And what you'll need to do is contribute towards the cost of the care. And what they look at is a weekly tariff of £1 for every £250 of value. So for every £250 worth of value between those two figures we quoted, 21,500 and 35,000, then you do pay a proportion of that of the care cost. So let's give an example of this one. So let's say you've got capital of £24,000, and that simply means you're £2,500 above the bottom threshold of 21,500. So that 2,500, we divide that by £250. So that's the chunk of each pound above it. And this simply means that under this scenario, you then make a further payment of £10 from your own account per week towards the cost of your care. Plus, remember, your contribution from your income streams as well. So this is the tariff payment. Now, the other thing that you need to be aware of, again, is the support that is available when it comes to the cost of care. So if you've got less than £21,500 worth of capital remaining, then you'll get additional support. And that support is £948.50 for nursing care and £825.94 for residential care. Now, if you wanted to, you could choose a home that's going to cost you more than this, and then you have the ability to pay the addition. Now, you do have options when it comes to funding long-term care costs, and just remember those options are there. But what I would say to you is always remember, though, to seek the appropriate financial advice. And when you seek the appropriate financial advice, I'd also recommend as well you shop around as well, because what you can do to fund care or help fund care can vary differently in cost. Now, one of those options for you to help fund care is where you purchase something called an immediate needs plan, which is technically an annuity. So an annuity is the equivalent of an old-style pension, where you give a lump sum to a third party, and what they will do, they will give you income in relationship to that lump sum. So let's give an example of how that could work. So this is Mary, and she's got poor health, and she needs care as soon as possible. And she's unable to perform some of those ADLs that we discovered or discussed before. So what Mary decides to do, Mary goes and seeks out an annuity provider, and that annuity provider will assess Mary's lifespan and they'll quote a premium to her. So they'll question Mary's health, they'll look at where she is on that the spectrum of the need for support, and they will assess her lifespan and give her a quote in relationship to a lump sum payment. Now, what Mary decides to do, if she hands over that lump sum, then what the annuity provider will do is then they will then pay the fees to the home free of tax for as long as Mary lives. So Mary decides that she's prepared to hand over the lump sum that the annuity provider has requested, and then the annuity provider will pay the home directly, and because it's not gone through Mary's hands, there's no tax or income tax for Mary to pay. Now, when you apply for an annuity or an immediate needs plan, the benefit you get can be level, so it's going to pay out the same amount, or it could be index linked to cost the rising, or to cover the cost of rising care homes. So care home fees, when they quote the fee, remember you've got the inflation aspect added on an annual basis. So if you go for a level premium, you might have to dig deeper in your pocket the longer you survive. If you go for an indexed option, then it should cover the cost of rising care homes. And what you decide to do will determine the cost of this immediate needs plan option right up front. And if Mary was to die very, very soon, then you can request certain guarantees, like you get a return of part of the fund as part of the overall strategy of buying the immediate needs plan. So that's one option where you can cover the cost of potentially going into long-term care. Other options you've got, and there are other options that are available for you. You could look at paying for care through different income streams that you may have. So it may well be you've got pensions or rental income, and you can use that to fund the care for yourself. But remember, care is so expensive for a lot of people that won't be an option. There are certain schemes in the marketplace, such as equity release schemes. Now, this is where ultimately you can release a proportion of the value of your home and use that to fund care. But what I would say is when you look at these release schemes, do seek the correct advice. Again, do take time to make sure you understand how the plans work, and be aware that when you are looking at some of these schemes, if you're not making a monthly payment back towards the organisation, then the interest they'll charge you will be compounding. So when death occurs and the house needs to be sold, you go back to the property, and because of that compounded interest, then you might not have any property to pass on to your estate. So just be aware of how these schemes work. And technically, under the equity release schemes, you've got two different versions. You've got a lifetime mortgage, is where you take a loan against the property. You can still live in there, your partner can still live in there, but that interest, remember, is compounding. So if you've got an option, pay some of that interest back, and that'll can keep the debt to what you've borrowed. But if you let the interest continue without any repayments, then it could ultimately mean on the event of death, normally second death, then the whole of the value of the house could be taken to cover that debt. So they can get quite expensive. Another option under an equity release scheme is where you apply for something called a home reversion scheme. So this is where you actually sell part of the property to the home reversion organisation at a discount, but you still live in that property. Now, once you've set up a home reversion scheme, you can't cancel it, it's irrevocable, and therefore it will continue irrespective until they make a claim on that. And that's when you either go into long-term care, they'll sell the home, or on death. But again, please seek the appropriate advice. And the other way in which you can fund long-term care for yourself is again by looking at the savings and investments you've got and making those payments from the returns you get on your savings and investments, or even just handing over your capital as and when required. So unfortunately, long-term care, it is confusing, it is very expensive. There are certain things we can do about it, but the key to this, though, is just understanding what those obligations are for ourselves and what support you do get from the government. So what's the next steps when it comes to long-term care? Well, what I would say is come back to some of the webinars we're running, because we do lots of webinars under this specific theme of estate planning, and you might want to consider the inheritance tax webinar, because again, that could explain how you can start reducing the size of your estate, but also avoiding inheritance tax going forward. So that kind of kills two birds with one stone. Also, for further information about care costs, I'd recommend you go to gov.uk, and there are regionalised areas for this as well. So specifically for Scotland, look at that. Age UK has got a lot of further information for you to look at. And again, it's a good site for you to find out about the cost of care in the regions that you're in. So that's your next steps for yourself. These webinars, they are a little bit more confusing than some of the other webinars, so I would recommend that you do come back and again at your own time, just so that you pick up more information the more you come back. Now, remember as well, we've got all the other materials available for you. So we've created information and education for you now, which goes all the way from birth, all the way through death. And I recommend you make the most of those webinars by just popping back on our platform on a regular basis. Make the most of it. It's completely free and it's designed to educate yourself so your life could be more fruitful. Now, if you do need to contact us, and feel free to contact us in the normal way. So you've got all the details upon the screen. And what I'm now going to do is I'm going to jump to a different screen just to answer any questions that have come through. So if you haven't got any questions yet, then drop them in the Q&A box. And I can see there are no questions come through. So what I'm going to say to you now, ladies and gents, is this. Hopefully you found the webinar of use. It is confusing, it is complicated, but make the most of the fact that this webinar will be run for you on a regular basis. Any questions, contact us in the normal way. And apart from that, enjoy the rest of your day. Take care. Bye-bye.